Okay, let's picture this. Imagine a company, right? Not just paying out its profits like usual, but doing it in a totally new way. A way that's like specifically designed to maybe outmaneuver some pretty savvy, sometimes aggressive players on Wall Street. That's exactly what we're going to dive into today. We're looking at this, well, really groundbreaking move by BTCS Inc. They're listed on NASDAQ, an Ethereum treasury firm. And they've made this pretty unprecedented decision. They're issuing a dividend, but in Ethereum, in ETH. And alongside that, there's this unique thing called a loyalty payment. It's a strategic play. Could really redefine how companies handle digital assets, how they interact with their shareholders. So our mission, for this deep dive, it's pretty clear. We're going to pull back the curtain here, look at the layers behind this decision. We'll try and figure out how it's meant to reward shareholders, especially the ones sticking around for the long haul. And critically, how it works is this like ingenious defense against market forces, like short sellers. Ultimately, we want to get a handle on what this means for the future,
For digital assets mixing more and more with traditional finance. And to bring you all this, we've gone through a whole stack of sources, big financial news names like Morningstar, CoinDesk, Cointelegraph, also direct company releases from Globe Newswire, and even kind of check the pulse on platforms like A-Invest and X. It used to be Twitter. Each one gives a slightly different angle, a valuable perspective on what is honestly a pretty significant event.
So, yeah, let's get started.
All right, now here's where it gets really interesting. BTCS didn't just, announce a normal dividend. They unveiled something totally new. They actually coined a term for it, a Bividend, like a blockchain dividend. And then there's this separate loyalty payment and the kicker. Both are paid out in ETH. So it's not just a quirky name. It really signals something, a fundamental shift, maybe. Okay, let's break down the specifics, the financial bits, because the details really matter here. BTCS announced this one-time Ethereum dividend, the Bividend. That's worth $0.05 per share. Okay, but like I said, they didn't stop there. They added this extra, actually more substantial loyalty payment.
That's $0.35 per share. You add those up, and you get $0.40 per share total, distributed directly to shareholders who qualify and paid in Ethereum. It's definitely a significant payout. And yeah, grab headlines right away. And the reason it made such waves, why everyone was talking about it, is because this isn't just any dividend. This is literally the first time a public company traded on a major exchange like NASDAQ has ever distributed a dividend in ETH. Think about that for a second. The magnitude of it. You've got a NASDAQ-listed firm working within the traditional system, but engaging directly with its shareholders using, well, a major cryptocurrency like Ethereum. It really is a huge step.
Exactly. It's monumental for integrating digital assets into traditional finance. And that point's been hammered home everywhere, right? Cointelegraph, CoinDesk, A-Invest even sparked massive discussions on places like Reddit. It's not just a technical first, is it? It feels more like a cultural, a strategic milestone.
Yeah, it definitely underscores this growing maturity, this acceptance maybe of digital assets within the established financial world.
Right. It signals a new frontier for how companies, especially those holding lots of digital assets, might unlock and distribute value. And, beyond just the novelty of paying out in ETH, which is fascinating in itself, the real smart part of BTCS's move, I think, is in the precise mechanics, the specific conditions they attached, especially to that loyalty payment. It's not just what they're paying, it's how they've structured it. It's all about achieving their strategic goals. So that extra bit, the $1.35 per share in ETH, the loyalty payment, it's not just handed out automatically to everyone right away. No, There's a really crucial condition attached. Shareholders have to transfer their shares into what's called book entry form, and then they have to hold them continuously through a very specific, quite far off date, actually, January 26, 2026.
Wow, okay. 2026, that's a long hold.
It is, and it's not a minor detail. It's absolutely central to their whole strategy. It tells you a lot about their understanding of market dynamics. Maybe just a quick refresher on book entry shares for anyone listening, because it really highlights the strategic importance here.
Yeah, good idea.
So most shares today are held electronically, right? But often they're held by your broker in what's called street name. This means the broker is technically the holder on record, and your shares often get lumped together in a big pool.
Okay.
And that pool of shares, it's easily available for brokers to lend out, often to short sellers.
Ah, right, the lending pool.
Exactly. So by requiring shareholders to specifically move their shares to this book entry form directly registered with the company's own transfer agent, BTCS is essentially trying to pull those shares out of that easily borrowable pool.
Got it. So it makes them harder to get hold of for shorting.
Precisely. It makes it significantly more challenging, more difficult for anyone wanting to borrow shares to bet against the company. These directly registered shares just aren't as accessible for lending. It's subtle, maybe, but it's a really powerful difference. It changes the game for market participants. So you see how this condition, holding in book entry until 2026, directly links to the company's dual purpose.
Yeah, it clicks now.
It's not just about being generous. It's a very deliberate invitation, really. An invitation for shareholders to kind of partner up with the company strategically. It encourages that long-term commitment, and crucially, it reduces the fluidity of shares floating around in the market shares that might otherwise be used for, let's say, opportunistic trading strategies. It's all about building this solid, committed base of investors, people who are truly aligned with where the company wants to go long-term. It sort of transforms passive ownership into something more like active strategic support. Very forward-thinking, I'd say.
That is fascinating because, yeah, it means this isn't just about sharing the wealth, is it? It means BTCS is taking this really innovative, maybe even unconventional path to distributing value. And like you said, this Bividend and the loyalty payment, they're not just about generosity. They serve this dual purpose, deeply strategic, both rewarding the loyal folks and, maybe more critically, protecting the company from certain market forces.
Okay, so purpose number one. On the surface, it seems straightforward, right? It's a direct shareholder reward. In a market like digital assets dynamic, sometimes pretty volatile companies are always looking for ways to align their success with their investors' success.
Makes sense.
So by distributing a chunk of their own holdings like Ethereum directly to shareholders, BTCS is basically saying, look, we believe in these assets, we hold them, and we want you, our long-term investors, to participate directly, to benefit from that belief right alongside us.
Right, it builds that connection. Yeah, exactly. It solidifies the bond with investors who are in it for the long haul, not just looking for a quick speculative profit. It signals confidence, a shared vision, and this desire to build a really stable, loyal shareholder base, one that can ride out the market ups and downs together.
An incentive for patience.
Exactly. Patience and conviction. Directly linking shareholder returns to the company's core digital asset stash. Okay, now purpose number two. This is where I think the move really shows its strategic, cleverness. Deterring short sellers, specifically the ones BTCS calls predatory short sellers.
Yeah, that distinction is important.
Right. So for our audience, you guys know how short selling works. Generally, borrow shares, sell them, hope the price drops, buy them back cheaper, pocket the difference.
It's the standard mechanism.
Yeah. But the predatory label suggests something more aggressive. Maybe high-volume shorts designed to just flood the market, push the price down regardless of the company's actual value.
That's often the implication. Trying to force a downward spiral, trigger margin calls, create panic.
Right. Which can seriously distort a company's real value, damage confidence. That seems to be the specific fight BTCS is engaging in here. So, by demanding shareholders move shares to book entry and hold them till 2026, that's the deterrent. Like we discussed, shares in regular brokerage accounts, often easily lendable, makes shorting simpler.
Right, part of the readily available float.
But moving them to direct registration with the company's agent, those shares are essentially what locked away from the short lending market.
Pretty much, or at least much harder to access.
So it dramatically shrinks that float of shares available for borrowing, which means it gets more expensive, more difficult for short sellers to actually execute their strategy.
Increases the cost of borrowing, reduces supply, basic economics.
Yeah. It doesn't just make it more difficult, like the press release says. It sounds like it makes it significantly more costly and less efficient for these predatory activities. Directly undermines their ability to push the stock down. And this isn't just some, happy accident or side effect of a dividend.
It sounds very intentional.
Absolutely. It's a stated, deliberate intent. We heard directly from the CEO, Charles Allen. He explicitly said the goal was to, quote, block predatory short sellers and build a stronger base.
Okay, so direct confirmation.
Yep. Crystal clear. This is a strategic maneuver. Proactively protecting their valuation, fostering that long-term shareholder alignment, and actively defending against what they see as market manipulation. It's a pretty bold statement of confidence in their assets and their long-term plan.
Yeah, and connecting this to the bigger picture, like you said, what BTCS is doing, it isn't really just an isolated thing, unique to them. This kind of innovative approach, it reflects a broader trend we're seeing. Companies, especially ones maybe feeling undervalued or finding themselves targets of aggressive shorting, they're looking for new ways to protect their valuation, to align incentives much more tightly with their long-term investors. It's a fascinating evolution in corporate defense, really, and it's also super important to remember This isn't BTCS's first time playing with crypto dividends. Not at all.
Oh, right. They did the Bitcoin one before.
Exactly. They set a pretty significant precedent back in 2022, issuing a Bitcoin dividend, the original Bividend, actually. So that earlier move shows that this current ETH dividend, it's not just a one-off gimmick. It's not some knee-jerk reaction to a specific market event.
So it's part of a pattern.
I think so. It points towards a consistent, carefully thought out, innovative shareholder engagement strategy. It reveals this longer-term vision for how they manage their digital assets, how they interact with their investors. They've been experimenting, refining this approach for a while, probably learned a lot from that first Bitcoin dividend. And this latest ETH Bividend feels like an evolution of that strategy. It signals a deeper commitment to using their crypto treasury in new ways, adding tangible value for shareholders, and yeah, shoring up their market position.
That historical context definitely adds weight to it.
And furthermore, while the medium itself, crypto, is obviously novel, cutting edge, the underlying strategic goal, it kind of echoes practices we've seen in other parts of traditional finance for years.
Like what?
Well, think about other asset-heavy companies, maybe tech firms with big patent libraries or commodity companies sitting on huge reserves. We've seen them use similar tactics, things like loyalty plans or shared lockups.
Okay.
The whole point is often to reduce market manipulation and align incentives with investors who believe in the long-term value. You might see bonus shares for long-term holders, or maybe special voting rights, sometimes even different share classes.
Right, I've seen things like that.
Or think about, say, the pharma industry. Companies often give substantial royalty payments to researchers, tying their success directly to how well a drug performs over the long run. Or even some private equity setups with lockup periods, performance incentives tied to long-term appreciation, not short-term trading.
Okay. So the goal isn't new, just the tool.
Exactly. What's truly groundbreaking here isn't the idea of a loyalty plan or a defense against shorts. It's the innovative medium. Using Ethereum to achieve these pretty traditional corporate finance goals, it's this brilliant mix, really. Old-school corporate defense tactics fused with cutting-edge digital asset distribution. It shows how blockchain can offer new tools for these age-old challenges.
Okay, so given how groundbreaking this all is, the obvious question is, how did the market react? I mean, when a company makes a move this bold, this unprecedented, especially tying into digital assets, the market usually has something to say, right?
Definitely. Investors vote with their wallets.
So was this innovation embraced, or was there skepticism? Well, the market's initial reaction was pretty quick, and for BTCS seemed overwhelmingly positive. Right after they announced the Ethereum Dividend and the loyalty payment, BTCS shares saw a pretty significant jump, climbed about 10% almost immediately.
Wow, 10%. That's a strong signal.
Yeah, that kind of immediate positive move suggests investors, at least initially, saw this strategy as a net positive. It signals confidence in the company's direction, its unique approach to creating shareholder value.
Or maybe some shorts getting nervous.
Could be that too. Maybe some short covering was part of it. Shorts seeing the reduced share availability, the company's confidence, maybe deciding to close out positions. But either way, it wasn't just a tiny ripple. It was a clear sign of market approval, suggesting at least some segment recognized that dual benefit shareholder reward and strategic defense. And this positive reaction, it makes more sense when you look at the underlying argument BTCS is making about its valuation. The company's been pretty open about what they see as this clear, persistent asset price disconnect.
Meaning their shares are trading below their asset value.
Exactly. In practical terms, if you look at their intrinsic holdings, mostly their big stash of Ethereum and other liquid digital assets, the estimates put that value around $6.65 per share. Yet, when they made the announcement, the share price was trading below $5.
Ouch, that's a significant gap.
Right. Pretty stark difference. Frustrating for any company, especially one with tangible assets on the books.
Yeah.
So this dividend and loyalty payment, they're basically designed to shout about this clear value opportunity to the market.
Like a signal flare.
Yeah. By giving ETH directly to shareholders and making it harder to short the stock, BTCS is effectively saying, hey, we think our stock is way undervalued based on our assets. And we're going to prove it by sharing those assets with you, our loyal owners, and making life tougher for anyone trying to suppress our value.
It's a strong statement.
It really is. Confidence, a proactive move to close that valuation gap, and a direct challenge to how the market currently sees them.
And it's not just BTCS's own story that's interesting here. It's also how the market reacted to its direct competitors, the other players in the crypto treasury space.
Oh, yeah. How do they fare?
Well, that difference, that disparity, it raises a really important question, I think. what does this divergence tell us about the competitive landscape?
Yeah.
How are investors starting to differentiate between these companies?
Are they prioritizing different things now?
Possibly, because while BTCS saw that nice positive bump, the picture for its peers, other companies holding lots of Ethereum, was quite different. Companies like Bitmine and SharpLink, who are in that same general area, their share prices actually declined after the BTCS announcement.
Really? Declined. Huh.
Yeah, and it doesn't feel like just a coincidence. It strongly suggests the market perceived a competitive advantage for BTCS, or at least investor confidence shifted towards BTCS's strategy.
So maybe just holding crypto isn't enough anymore.
That seems to be the implication. Investors might be looking beyond just the raw amount of digital assets a company holds. They seem to be paying more attention to how those assets are managed, leveraged, distributed to actually create shareholder value.
Passive holding versus active strategy.
Exactly. The market seems to be signaling that just accumulating assets might not cut it anymore. And just to give some context on BTCS's holdings, at the time they held 70,000 ETH, that was valued around $303 million, put them 11th among public ETH treasuries.
Okay, still significant.
Definitely significant. But then you compare it to rivals. Bitmine, for instance, holds a massive 1.5 million ETH.
Whoa.
Yeah. And SharpLink has around 728,800 ETH, so vastly larger reserves than BTCS.
Okay, huge difference in scale.
Right. Which means BTCS isn't trying to compete just on the sheer scale of ETH they hold. While those larger rivals might be focused on just growing the pile, maybe acting as a simple way for investors to get ETH exposure, BTCS seems to be emphasizing innovation, how they manage and reward shareholders with the assets they already have.
So it's about maximizing the value of what they've got, not just getting bigger.
It suggests maybe two different models emerging for these public crypto treasuries. One is focused on passive appreciation, riding the ETH price wave through sheer scale, like Bitmine, maybe. The other, like BTCS, is focused on active strategic deployment, value extraction, corporate defense, shareholder engagement.
And the market seems to like the second model right now.
The immediate reaction suggests investors are increasingly favoring companies that show that innovative value extraction, that strategic alignment. Perhaps they see it as a more robust, maybe more sustainable path long-term, especially in volatile crypto markets.
Interesting.
It really makes you wonder how these different strategies, accumulation versus extraction and defense, will play out long-term, doesn't it?
Yeah.
Are we seeing maybe the start of a new standard for managing digital treasuries, moving beyond just HO dealing towards active shareholder-focused strategies?
That's definitely a powerful shift for investors to think about. So, okay, stepping back. What does this all mean for you? For anyone listening who's interested in this intersection, where traditional finance meets the fast-moving world of digital assets, this BTCS move, it really sparks some big questions about what's next. One huge implication, I think, is just the accelerating pace of digital asset integration, getting them into the mainstream financial system. I mean, a NASDAQ-listed company paying dividends in ETH, that's not a small thing.
Definitely not.
It signals this growing institutional comfort level with crypto, moving it beyond just niche speculation, embedding it within the established rules of corporate finance.
It normalizes it.
Yeah, exactly. BTCS's action directly challenges the old norms, makes a strong case for crypto assets as legitimate parts of a company's treasury and as a viable way to distribute value to shareholders.
Could pave the way for more seamless integration.
Right. A more interoperable financial system where traditional and digital assets flow more freely, that could ultimately make global capital markets more robust, more flexible. And building on that, you absolutely have to wonder if this BTCS move could become a kind of blueprint for others.
A playbook, yeah.
Think about it. Any public company sitting on a pile of digital assets, or even just companies looking for new ways to reward shareholders and defend against market pressures.
They might look at BTCS as a case study, a pioneer.
Could we start seeing similar Bividends pop up more often in quarterly reports?
Yeah.
Especially if this strategy works out for BTCS, if it reduces short interest, locks in long-term holders, closes that valuation gap.
It sets a powerful precedent.
For sure. It shows a whole new way for companies to distribute value using blockchain, using the specific advantages of digital assets. Imagine like a gaming company distributing rare in-game items as dividends.
Or a tech firm tokenizing some IP.
Yeah, distributing ownership through similar mechanisms. The possibilities are kind of mind-bending. But okay, let's be realistic too. While the opportunities are huge, we have to acknowledge there are challenges. right?
Yeah.
Complexities for companies thinking about doing this,
Oh, absolutely. It's not simple.
like operational hurdles.
Yeah.
Just managing large-scale crypto distributions, that's got to be tricky.
Definitely. Smart contracts, gas fees, security for big transactions, setting up wallet systems for potentially thousands of shareholders.
Right, and then there's a whole compliance maze,
Hmm.
multi-jurisdictional stuff.
Huge challenge. Different countries have wildly different securities laws, crypto regulations. MiCA in Europe, the SEC's stance always evolving in the US.
You need serious legal navigation there.
Meticulous navigation. And, yeah, without giving tax advice. The
Yeah.
tax implications.
Oh boy. For the company and the shareholders receiving crypto.
Incredibly complex, constantly changing, needs super careful consideration.
And finally, just communicating it all.
Yeah.
Explaining the process, the benefits, the risks to shareholders, many of whom might be totally new to crypto.
Yeah, education is key. These are all real-world hurdles companies would need to tackle very carefully. And connecting this again to that bigger picture, this innovative move by BTCS, it really forces us to rethink what shareholder value even means in this increasingly digital economy. Which leads to a pretty important question. How might these new tools, like crypto dividends, fundamentally reshape what investors expect from companies down the line? Could we be looking at a real paradigm shift in corporate finance? Think about how Bividends might start to shift those expectations. Historically, yeah, shareholders expected cash dividends, maybe stock dividends, standard stuff.
Right.
But what happens when companies start giving out bits of their digital asset holdings directly? Will some shareholders, especially the crypto-savvy ones, start demanding crypto dividends as an alternative or maybe even on top of cash?
Could create different classes of investor demand.
Exactly. You might see this split in preferences. Companies might need to tailor their dividend strategies, offer cash for some, crypto for others.
That adds complexity, but also flexibility.
Right. It adds a new dimension to how investors evaluate a company's returns, its forward-thinking strategy. It could reward companies that are agile, innovative in how they allocate capital. And looking even further out, you have to wonder, cautiously of course, is this just an outlier? A unique move by one company in a specific sector? Or is it really the start of a much broader trend in corporate finance?
The first domino.
Could be. As more companies across all sorts of industries start holding digital assets, ETH, Bitcoin, NFTs, maybe even their own tokens, this model could look increasingly attractive.
You mentioned a tech company with a blockchain division.
Right. Imagine them issuing a Bividend in their own native token. Or a luxury brand tokenizing unique items and offering them as a special dividend. It just expands the corporate finance playbook way beyond traditional tools, opens up totally new ways to distribute capital, engage shareholders. It's not just about paying out. It's about innovating how value is created, transferred, perceived in a truly digital age.
So maybe a glimpse of a future where value is distributed not just in dollars, but in all sorts of digital assets.
Yeah.
Tied directly to the company's business.
It could be a future where corporate value distribution looks very different. And finally, just to circle back to that core strategic battle underneath all this innovation, it's that fascinating push and pull, isn't it? Between the long-term aligned shareholders and the sometimes aggressive strategies of short sellers.
The ongoing tug of war.
Exactly. And crypto dividends, especially these loyalty programs tied to them that restrict share lending, they offer a really powerful new weapon in that dynamic. Gives companies a direct way to solidify their long-term base, shrink the float available for shorting, and basically fight back against perceived manipulation and undervaluation.
A new tool in the corporate defense arsenal.
Absolutely. It's a compelling evolution in that perpetual struggle for control and valuation in the public markets. And BTCS, they've just thrown a significant new curveball into the game.
So we've taken a pretty deep dive here into BTCS's, well, unprecedented Ethereum dividend and loyalty payment. Uncovered those strategic layers, rewarding shareholders, defending against shorts. It's a really fascinating glimpse into this evolving landscape where Wall Street meets Web3, traditional finance meets digital assets. Truly a first of its kind.
Yeah, what's really fascinating, I think, is how one seemingly straightforward financial announcement can reveal so much. Sophisticated corporate strategy, complex market dynamics, the sheer versatility of digital assets now. It's all in there, which raises an important question for you listening. If you were a BTCS shareholder, how would you see this? Just a financial perk? Or would you view it more as like a strategic commitment? A sign the company is embedding digital assets into its core and actively defending its long-term value.
And as you mull that over, here's something else to think about. In this world that's being increasingly shaped by digital innovation, could we actually see the traditional cash dividend start to fade away for certain types of companies, replaced by these asset-specific payouts. Things that align more closely with what the company actually holds, its strategic vision. What other kinds of assets might companies start distributing to shareholders in the future? Could this become, the new normal for valuing and rewarding investors in this digital age? Anyway, if this deep dive hit the mark for you, if it helped you understand the nuances of this pretty incredible development, please do consider hitting that like button, subscribing to our channel, maybe ringing the notification bell. Your engagement, honestly, it really helps support what we do here, boosts visibility in the algorithm. Let's just keep delivering these kinds of insights, trying to bridge Wall Street and Web3. We genuinely appreciate it. Thanks for tuning in.